Good morning, everyone, or good evening, depending on where I find you at the moment. Welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Firstly, thank you all for your attendance. We've had over 250 people register for today's webinar, which is a fantastic turnout. Today, we have AXP Energy Chairman Simon Johnson and Managing Director Tim Hart, who will be discussing the company's quarterly results and other near-term value catalysts. Following the presentation, both Simon and Tim will be available to address any questions you may have. Please feel free to send in your questions via the chat platform in the question pane in the GoToWebinar control panel. You can also email them to me at alex@investorstream.com.au. We've already been inundated with questions thus far, so we may not be able to get to every single question that's submitted, but rest assured that we'll any questions that are submitted will be forwarded to the company so they can be answered in due course. The presentation has also been lodged on the ASX, but if you haven't had a chance to download it from that platform, you can also download a copy of the presentation by navigating to the handouts pane in the control panel. And in that pane, there's also a copy of the quarterly for you to have a look at as well. Finally, a copy of the webinar will be available on AXP's website and social media platforms later today. But for now, I'd like to throw it over to Simon, who's going to kick things off for us. Simon, the floor is yours.
Thank you, Alex, and thanks everyone for dialing in today. As we sort of talk today, I'll draw your attention to the usual forward-looking statements disclaimer. We're going to be sharing information about the company. Some of that is, projections into the future, and we ask you just to be mindful of the forward-looking nature of those. Next slide, please, Alex. Yeah, so what you see before you is a synopsis of the results that we've recently announced to the market. Things are going very well for AXP at the moment. We're starting to see the contribution of the MHP and Tray assets in terms of our production figures. This is our second quarter with those assets included in our figures, and this is our first full quarter. As you can see, net revenue has performed extremely well. Customer receipts are up by a substantial amount as well, and altogether we sold almost 28,000 barrels as compared to the prior quarter of 24. Gas sales were up as well, and our NGL sales were down slightly, but at adequate levels. The company is well financed at the moment. We have around about $4 million in cash and cash equivalents, excluding unsold oil on hand. So right now we have no need for immediate cash to continue the business's activities. We had a large sell down in the oil inventory, which generated a lot of cash for the company as well. And as we've been saying for some time now, we're leaning into this improving underlying commodity price, both on the gas and on the oil side. So right now, with the improvement in the commodity price, we've been really focusing on growing the top line, the sales that are inbound for the company. We still have a lot of energy internally directed to improving the cost side of the picture as well, but that's sort of a longer term project. And given the trajectory of the oil price and the gas price, we've really been focusing on what we can do on the revenue side, and that's where the most bang for the buck lies for us right now. Moving on to the next slide, please, Alex. So here's just a bit of a description of what's been happening on the revenue side. You can see since April, we've experienced steady growth in our revenue profile. Some of that has been sort of chopping and changing between oil and gas, depending on what's been happening in the field and what's been happening with our offtake. But I think the overall trend is clear and very positive. That revenue continues to climb up to the north, which is a testament to the work that Tim and his team are doing in the field every day. And it also speaks to the work that Tim and the team have achieved in terms of renegotiating some of the historical contracts for gas sales in particular. And when you look through, across the business's portfolio, it's one of, quite sort of incremental improvement. So as I say, you're starting to see the benefit of the oil haulage improvements. We've done some things with offtake of the oil in particular, with trucking, bringing certain functions in-house, and all of that is helping us to both sell down the inventory cushion that we built up through time and just to improve the performance of the operation in general. Next slide, please, Alex.
All right. I too would like to thank everybody for joining the webinar. I'm going to be taking the next series of slides and discussing a couple of operational things, and then we'll pass it back to Simon and Alex. Thanks for the introduction. So, if we look at this production and development overview, the team was extremely busy this quarter. And in summary, we moved about 33 wells from idle to producing. 13 of these were workovers, but 20 of them were in the KJ field. That KJ field was segmented from the rest of the asset, at least from a pipeline disruption due to mining. And so we have laid about 10 kilometers of pipeline in that KJ field to bring some of those wells back online. This quarter, we brought 20 of the wells in the KJ field back online. That project is not a project where the entire pipeline has to be in service in order to reap the benefit of the wells. And so as we lay a little bit more pipe, we bring a few more wells back online. So we've been realizing the production enhancements from some of the wells in that KJ field as we go along. And in general, we've yielded about 133 barrels of oil equivalent for the quarter and have spent $129,000 on these activities. And so, it's a pretty good success story there, and there's plenty more to come. We've identified 129 additional wells as workover candidates, and some of the workovers on these 129 wells have commenced. And let me explain that, workovers are a core part of our business. And so although, we've got 129 on deck, there will always be a pipeline of workovers. It's part of what we do with our enhancement activities of the asset. Our well portfolio is fairly substantial now, and so there are always improvements to be made. Certainly we look for the biggest bang for the buck first, and we'll continue to do that, but workovers are a core part of our business, and it's just something that we'll be doing for the rest of our lives. So, we've also identified wells that have historically been categorized as plugging candidates, and those are being reevaluated for the in situ power generation project. We are finding a lot of wells that we had anticipated were going to be plugged that can be repurposed for that. And let me explain just a little bit about that. So we've got wells that are fairly remote, and although they might have decent production, there's no pipeline to a sales channel, and the pipeline build out to a sales channel is cost prohibitive. Well, so that production might not warrant the build out, but with the crypto requirements, we can set a gas to electric generator and provide in situ power right on site. And so this is an absolute game changer for us. And we're positioning ourselves to take full advantage of this. Oil production varies. It was on average 260 barrels of oil per day over this quarter. Gas production's up a bit. I expect these numbers to continue to grow as we continue to execute our enhancement strategy. Move on to the next slide, please, Alex. Okay, so here we can see a few pictures from what our Colorado Pathfinder site looks like today. These pictures were taken yesterday, actually. So this is the first power generation site that we are setting up for Elite Mining for their crypto mining hosting operation. And so we're providing power for them for this operation. In the bottom right-hand picture, you can see 3 of the Elite Mining's EMUs and plenty of pictures of the cooling equipment and a few pictures of how things are oriented on the site. And so let me explain a little bit about how this works. So we've got multiple stranded gas wells in Colorado. And they're currently sitting idle. And the reason that they're sitting idle is because they make a lot of gas, and this gas cannot be flared. there's no transport infrastructure in the field. And so this arrangement with Elite provides an outlet for that gas. But what might not be apparent is that in addition to that outlet, we get oil production from these wells that we can't realize otherwise. And also in addition to that, we get liquids production. And it just so happens that the liquids in Colorado are very rich, 3 to 4 gallons of rich liquids per MCF. So there's a tremendous amount of liquids in this field if we can consolidate this gas and bring it all to a single point and harvest those liquids. So the oil production's immediate, but the liquids need to be stripped out. And so this is going to require some infrastructure. We've looked at the sales market for these liquids in the area, and there is a good market for them. And so we're proceeding with this planning, but I want to be clear that it won't be immediate. We might need to lay some gathering lines to consolidate the gas in the field so that we can assemble those liquids into a stripping facility and take full advantage of the resources out there. So this is a material thing for this field, and it will have a significant impact on the economics of the field. So we're pretty excited about this this new development and intend to take full advantage of it. And the other thing I want to mention is this, this isn't only common to Colorado. This power generation opportunity for crypto mining, it's gaining just a tremendous amount of speed here in the US. And the interest in our gas as a result of this has been absolutely out of sight. We've identified several hundred wells that are ripe for repurposing the gas for this activity. Some of you might not know that the governor of the state of Kentucky has passed into law a crypto mining incentive bill to entice crypto miners to move their mining operations into the state of Kentucky. And the kind of things they're doing are offering sales and use tax exemptions, and exemptions. They exempt electricity that's used or consumed in the commercial mining of cryptocurrencies. So it's a pretty big development for the state that that we operate in the most. The other thing is for those who are in doubt, cryptocurrencies really are here to stay. They're gaining in popularity. The city of Miami started their own coin called Miami Coin. If you mine it, you get 80% of the coin, and the city of Miami gets the other 20%. And the revenues have been so significant that they're looking to replace their city taxes with Miami Coin revenues. So these are the kinds of things that are happening in the crypto mining space. We are power suppliers to that industry, but to the extent that the industry stabilizes, you can see that the opportunity for us increases. And it's absolutely our intent to build out our infrastructure, to assemble our operations, to take full advantage of that opportunity as it continues to materialize here in the U.S. And I can't overstate that enough. I think it'll have a material impact to our business on an ongoing basis. Slide 7, please, Alex. And so, we're working to try and disseminate the near-term value drivers and initiatives in this slide. So obviously, the most critical thing that we have is our production. We have positioned ourselves to have some very, very good core assets, and consequently, we execute a workover program to increase the production in those assets, and that workover program includes pipeline repairs and turning wells back online that have been offline for a bit, enhancing the production. And again, this is a core part of our business. It'll be something we do every single day, and so just kind of be understanding of that, because you'll probably hear more and more about it. The other thing is bringing the Trey exploration assets in-house. So we acquired Trey, but those assets are now being moved over under our operatorship. And so that means that we're applying our disciplined approach to managing and enhancing those assets, just like we have the legacy MHP assets that we acquired in Eastern Kentucky a while back. So, and with our asset base, we've got a tremendous amount of acreage and along with that acreage comes exploration opportunities. And I want to be clear here that we're talking about low cost, low risk opportunities. We're not talking about, you know, drilling wildcat wells or anything like that. We're looking at, you know, drilling infill drilling locations. There are plenty of wells that you know already have known production nearby, and these are just offset wells. And they're low cost wells because they're shallow. We're drilling them in the Illinois Basin. And so we are developing an exploration program. It's hard not to be enticed to do that with the price of oil exceeding $80 a barrel and forecast that's going to go to 100. And so we're looking at this very seriously. And the other thing is the NGL production in Colorado. I think I've covered that well enough, but this is certainly going to be a big value add for the Florence field. Another one is in situ power generation. Again, you know, we're further developing that elite mining relationship, starting with the Colorado site, identifying all of our stranded wells across our entire portfolio to be repurposed for in situ power generation for all the stranded wells. And quite frankly, we intend to be the energy partner for the crypto mining operation that's happening in this country. Reserves reporting. So most of our work for our resource and reserves reporting is complete. I know we promised these reports and we're running a little bit late. We promised them by the end of September. It's past that and we haven't distributed them yet. One of the reasons is that there were lots of new data to get through. You know, these assets are new to us, and we're using multiple engineering firms, so the coordination has increased, etc. And so, but we're almost there, and I thank you for your patience. We have about nearly all of the work done, and we're reviewing and assembling the final information, and we'll get it out to the market shortly. A couple other things. Some of you might not know that that we have nearly $1 million in cash bonds that are held in escrow to cover our wells, and we're working to get these bonds moved to insurance bonds to free up that cash so that we can repurpose it to grow the company even more. Downstream reliability is something that we're working hard on. The things that we have control over in our own field, it's a lot easier to put the infrastructure in place and the redundancies in place that we need in order to keep our flows moving and our production moving. Downstream vendors, you know, it's a little bit more difficult to influence them to get that done. Some of them do very well, and some of them need some improvement. And so we're working with those downstream vendors to improve that reliability where it can impact our bottom line. So those are all things that are happening, and we believe are going to have a substantial increase in the value of the company on a go-forward basis. And with that, Simon, I'll pass it back to you.
Yeah, look, just in closing, thanks, Tim. Just in closing, we wanted to, you know, remind everyone of this simple but rigorous model that we've developed that explains, you know, how we work every day. So we've also received a number of questions about where the name AXP comes from, and I'll just take you through the three components of our our overlying principles, if you like, in terms of how we acquire or screen assets for acquisition. What we do with those assets, how we enhance them, which, you know, is the X factor in AXP, and then lastly, how do we manage the portfolio? So, you know, in terms of the acquisition side, we put a great deal of effort in being aware and surveilling the market for new opportunities. We're at a time of tremendous churning of potential assets in the United States. There's a lot of people getting out of oil and gas, and that's creating opportunities for us. I think the way that the business is managed today is very, very different than the way it needed to be managed just a short while ago. And we're seeking to adjust that. And the work that Tim has been doing in the power generation space in support of this crypto mining operation, that's an example of us searching out some of the things that aren't immediately obvious to entrenched industry players that, you know, may provide an opportunity to grow the company in a new way. On the enhanced side, as Tim, you know, spoke to just now, we are doing a lot internally to very carefully at the cost base and to see if there's better ways that we can do things. And I think, you know, there's the opportunity for sort of horizontal growth for the company in terms of acquiring new assets, but there's also potentially on the cost side opportunities that arise out of vertical integration and bringing functions in-house that previously would have been routinely outsourced. And I think that also is going to provide the company with a measure of resilience as, you know, the marketplace becomes more challenging for oil and gas operators in terms of access to personnel, access to equipment, and access to suppliers. So that's the enhance element. And then lastly, there's the produce element. And this is really, as I say, about how we manage the portfolio. And, you know, we have a large inventory of wells on hand today, and we are actively managing that. We're constantly making sure that we're abreast of our abandonment liabilities and managing the portfolio in such a way that as we produce more and more of the hydrocarbons, that we're, you know, continuing to retire wells when required, and where possible to prolong the productive life of wells. And, you know, this is just going to be an ongoing part of the business. This is increasingly not, it's a liability that needs to be managed. It can't be sold down the road, and we're grabbing that bull by the horns, and we'll continue to manage it going forward. So with that, Alex, I don't think we have anything more to say in the presentation. We're keen to take as many questions as we can, so I'll pass it back to you.
Thanks, Simon. I'll address this first question to Tim. Where are we at in terms of the OTC upgrade?
So we are eager to get the OTC upgraded completed. Unfortunately, the suspension that we had made it very, very challenging to advance that at the pace that we wanted to. So, you know, my anticipation is that OTC upgrade will be coming out in the near term. We still have some work to do on it as we were sort of, we had to push the pause button on that while we went through the suspension. So, you know, while I can't make any specific estimates on that, I would certainly anticipate that that it'll be done in the near term, and by that I mean, you know, probably a month, maybe longer.
Thanks, Tim. Now, Simon, Tim mentioned just before the resource data that was promised months ago was delayed. You're including new data. Would you be able to, I guess, expand on the new data that's been included, and how long are we expecting that delay to be?
Yeah, sure, Alex. Yeah, I think as Tim said, this is going to be our maiden reserves report for the integrated company as we bring all those assets into the mothership. So the previous owners were local US companies. They don't face the same comprehensive reporting requirements that we face as a listed ASX company. So in addition, there's been a lack of historical information on some of the leases that we've acquired. So we are late. We're very conscious of that fact, as Tim conceded. We previously communicated that, you know, we would hope to release that in, you know, late September, October. We're almost finished. So we have just one of the assets outstanding. I think Tim mentioned that. This is going to be our baseline for exploitation of these assets going forward. So we want to do this properly and carefully. And you will see something from us in coming weeks, not months. As Tim said before, we've almost finished. It's going to be, this is a very important piece of technical work for us, and will drive our, you know, our exploitation strategy going forward.
Thanks, Simon. Tim, can you just expand on where we're at with the gas supply and oil production with Elite Mining? How many installations will there be, and what returns are you expecting to AXP?
So we're laser focused on this first site. The first site, I think, will allow us to better estimate some of the answers to these questions. We have taken a stab at answering some of them in terms of what we expect the returns to be. The reason it's a bit difficult to predict those things is because you know, we're going to be supplying some gas to the first site, which means that we're going to be holding those wells back. What impact that'll have to the oil production, we're not sure. and time will tell that. Certainly there will be oil production and NGL production and gas production, but until we get one or two of these under our belt, it's going to be more difficult to predict those things accurately. How many installations will there be? I can tell you that Elite Mining has plenty of pipeline for us, and my anticipation is that there will be as many installations as we have gas to supply. So they come in varying sizes and shapes, and so it's difficult to estimate the count, but rest assured that there's a significant pipeline, and every ounce of stranded gas that we have has a home ultimately in power generation.
And Tim, when do you expect the K pipe rework to be commissioned?
So that, as I mentioned a little bit earlier, that KJ pipeline, it's one side of it is connected to the main pipeline, and we're just expanding that side. So it's not an all or nothing. The KJ pipeline build-out project is about 75% complete, and we've been reaping the benefit of turning those wells on as we've advanced that pipeline. So my anticipation is that it'll be completed within this quarter.
Thanks, Tim. Simon, can you just give us a bit of an update on the progress, or the latest on the progress with the other well reworks and connections?
Yeah, sure. Look, we've been giving the market a bit of colour on our activity in this area, mainly to give people a taste of what, as Tim mentioned before, is increasingly going to become an activity at the core of what we do. So we've been continuing to progress the workover program that we sort of outlined some time ago. We're gaining some incremental production from that, but I think going forward, you're probably going to see us reporting less and less of the granular detail, not because there's it's not worthy of reporting, but just simply because it's going to become a routine activity. As our portfolio grows and as we do the technical work to refine where we're going to focus our energy across what we've inherited from Trey and from MHP, I think you're going to see the results increasingly communicated through the sales and revenue lines of the report, rather than sort of detailed esoteric workover reports, production improvement reports. So yeah, I mean, what I'd say is this is increasingly is going to be a daily activity for us, and really what we're trying to do at the moment is work out how we can do more work in parallel to get the production up and to renovate some of these old wells and extend the productive life of the ones that are already contributing to the top line.
And Tim, where are we at with the second crypto mining gas supply discussion?
So that second site is moving forward in parallel with the Elite Mining site in Colorado. Some of the equipment has already shipped to site. We're waiting on some of the more core components before we actually start to prepare the site, but my anticipation is that you'll hear more about that installation in the near term.
Now, Simon, regarding other opportunities you're seeing, and I think you might have referenced it just before, are you currently eyeing more acquisitions in your operating area? And in terms of the opportunities that you're seeing, are they located nearby to your current location?
Yeah, look, we're constantly on the lookout for opportunities to add assets opportunistically. As I mentioned, we've got a very strict screening criteria. Those, they need to have either a deep strategic opportunity, or they need to be immediately accretive, and ideally both. So yeah, I can't sort of go into detail about sort of what's in front of us right now, because obviously we're in competitive situations, but I don't think there's too many opportunities in the basins that we operate that we don't know about to continue to grow the company. And we're going to be continuing to surveil that space. As I said, the market at the moment is very dynamic. There's a lot of people exiting the space. Conversely, financing of acquisitions is challenging for oil and gas companies in the current environment. But we're trying to find a way that allows us to add to the company's productive base, deliver value to shareholders, and at some point move from a growth strategy to one that's focused more on harvesting cash for the shareholders. That opportunity is not happening tomorrow, but it is down the road, and that is our end goal.
And Simon, what are the potential rewards for the carbon capture, and where are you at with this opportunity?
Okay, we actually have a consulting resource that we've identified and communicating with at the moment to look at this issue specifically. Some of it lies right in the middle of carbon capture technology, and some of it, is more at the edges and is, shall we say, a supporting or enabling technology or opportunity. In similar vein to the in-situ power generation that we've developed, we're looking at every corner of the square for opportunities to either, use the company's assets and infrastructure in an imaginative and new way. Carbon capture is definitely one that we haven't done as much work in to date, but when you look at what we've got across our various fields, we have a lot of pipelines and we have a lot of depleted reservoirs. There's also opportunities that may arise through the crypto mining activities that we're supporting in the form of gas delivery. So we're looking at all those things at the moment, and we're going through, at the moment, a bit of an exploratory survey. That'll be followed by a ranking study. And then we're going to be looking at sort of where we lie competitively as well. And that's, once again, it goes back to that organogram that we shared with you at the end of the presentation of how we intend to build the company going forward. We're really trying to come up with some systematic, process-based evaluation tools for looking at things, and certainly carbon capture and storage. That is, we believe, going to be an opportunity for the company. Our plans just aren't advanced enough yet to give you much color about what direction and form and shape that might take. But we do have, as I say, have a consultant employed on looking at that specifically.
Thanks, Simon. Tim, is the company looking at drilling new wells, and if so, when and where?
So as I kind of alluded to, we are looking at developing a drilling program. We would be remiss not to do that in the current pricing environment with oil. You couple that with the tremendous opportunities that we have in the assets that we've assembled, more specifically centered around Western Kentucky. We're looking right now. We've got the old Exxon field that we acquired through Trey. And there are a number of formations in Western Kentucky that there's some current drilling going on, and they're having some serious success right next door in a couple of our leases. And so the team has been working to do some geologic studies and figure out where we want to drill first, stack rank those drilling locations, and then put a plan together. And then do some drilling. And as far as I'm concerned, that can't happen fast enough, because I know there's some tremendous opportunities out there for us to capitalize on. My anticipation is that we probably got another 30 days of geologic analysis, putting the drilling program together, and we're probably a couple of months away.
Thanks, Tim. Simon, can you just explain why AXP's share price is still only 1.5 cents against your peers, 88E, Elixir, Cooper Oil, and Oil Search? Obviously, there's quite a disparity between the share price in terms of your competitors. Can you just talk us through why the share price still only hovers around the 1 to 1.5 cent mark?
Yeah, look, it's a matter of some frustration, and certainly management and the board talk about this quite a bit. It has improved dramatically of late in percentage terms, but it's nowhere near what we think the underlying potential of the company should be rated at. I do think that with the group that you just mentioned, some of those companies have different profiles to us. I mean, we're not a oil exploration company. We're a in-basin acquirer and production enhancer. So of the ones that you mentioned, probably Cooper and I think Oil Search are probably the closest analogies to us. They're much bigger concerns and operations than we are, but we aspire to be like them and to be kind of rated in the same way in terms of the the share price value. So What I can tell you is that we sense great excitement about where the company is going. Their events of late have largely resulted from us putting distance between events of the past and what our new strategy is. We're going to continue to share our plans with the market. We're going to continue to deliver and execute, and we think that once people get used to that, and assuming that it occurs on a metronomic basis, then I think you'll see the share price start to respond as people build confidence in what we're doing as a management team and as a board of directors. We're all very conscious at AXP in terms of the staff and the directors that we serve at the shareholders' pleasure. And yeah, it's we're on a journey here. We're at the beginning of it. There's been a substantial shift in the strategy, and it's going to take a little bit of time for that value to flow through to the share price. But you are seeing the early signs of response in that regard, and we believe that that's going to continue to improve as we continue to deliver good results.
Thanks, Simon. Now, Tim, going back to the quarterly, other revenue increased by around 82% in September compared to the first 2 months and represented 64% of total other revenue for the quarter. Why did it increase by so much over the month or the quarter? And what are the main contributors to other revenue?
This other revenue, we have other working interest partners. It's not a significant amount, but we don't have 100% of the working interest for every one of the wells. And so this other revenue is the revenue that we have in billing the working interest partners back their share of the operating costs of those wells. And there was a substantial increase in that in this past month because we brought oil haulage in-house. And so now we have our own tankers, we have our own drivers, we've got our own trucks, and we're moving that oil ourselves. And so you would notice by the quarterly that oil haulage had picked up substantially over this last month, and it's reflected in that revenue.
Thanks, Tim. Simon, what's your plan moving forward to create a name for yourself and AXP within USA markets?
Okay, I guess this relates to the OTC question earlier. Well, I think there's two elements to that. On an industrial level, just through our activity in the market and our participation in the deal flow in the basins where we currently operate and are adjacent to, I think Tim's team have done a great job at improving the profile of the company. So in the Southern Appalachian Basin, the Illinois Basin in particular, I think we're seen as a player now. We're active in, as I say, in the deal flow. We're doing lots of things potentially collaboratively with other producers in the basin, and I think we're about as active as anyone could expect us to be on that level. In relation to anything that we might do in time on the OTC, well, I guess there will be an obligation for us to do a lot more to inform the US investor base. So really what we need to do there is simply act in parallel and devise a way to keep the US investor bases informed on an equal basis with the Australian investor base. Others have done this and are doing this, so we don't think that's necessarily a massive challenge. We just need to assign some resource and be a little bit more careful about the process of how we manage information flow to ensure that everyone's informed equally, I guess. I hope that answers the question.
I think it does, Simon. And just on that, can you speak to the rumours of dilution recently, and do you have plans to issue any more options?
Yeah, look, I don't know where all this dilution talk comes from, frankly. We've been trying to be consistent in terms of how we're running the company. We're seeking to maximise the organic cash flow that operations can produce. As I mentioned earlier, we do see the opportunity for transformative acquisitions going forward, and they will need to be financed. I think one of the challenges for oil and gas companies at the moment is, traditional sources of lending have been shut off, and there is, with the ESG concerns around the oil and gas space generally, it's becoming harder to raise capital across a broad spectrum of sources. So what I would say is that obviously we're focused on running the business for cash and effectively is more important than ever in that environment. However, if we see the opportunity for a transformative acquisition, then we may need to issue shares there. In terms of the options that have been issued recently, they result from events from at least 12 months ago. So they should be baked into people's expectations about the shares on issue, etc. We're focused on growing the value of the company, not on diluting shareholders. And we do have a core group of shareholders who have supported the company through thick and thin. And sort of efforts to not dilute are very high on our screening criteria.
And so what do you plan to do with the 4 million in cash, and is a share buyback on the table?
Look, there's lots of different ways to return money to shareholders. At the moment, I think the opportunity set that we have is exciting, and the company's in an expansionary phase. So we're trying to be opportunistic about gathering as many assets at the best price point that we can. We're not sort of going crazy buying things. We've been very, very selective and targeted. The things that come to the market in terms of where we've shared information with the investor base, you'll see that that is at the tip of the iceberg in terms of the flow of opportunities that comes over Tim's desk in particular. So at the moment, the $4 million gives us a good sort of near-term cash buffer. We're looking to utilize that in the day-to-day running of the company. Share buybacks, extraordinary dividends, all those things are great things to do, but I don't think the company is at a point right now where it can do that on a sustainable basis. The opportunity for the company right now is looking through the assets that come up for sale and to continue to build the company's production out, to harness those cost synergies, to get to what I consider to be a minimum efficient scale in the basins where we currently operate. And then in time, but it's a medium long-term goal, then we can look at ways in which we can return the money that we generate to shareholders. But that is not the time. It's at the moment we're looking for we can better use that money in growing the base of the company, I think.
Thanks, Simon. Tim, given the recent halt on the AXP ticker on the ASX, would you consider moving to the OTC fully in the future?
Well, I mean, at the moment, we are focused on our dual listing, and it would be hard to speculate beyond that. We certainly are fond of the OTC. We've had a long-standing relationship with the ASX, and I guess I would anticipate, at least at the moment, for those relationships to continue. It's hard to speculate, what happens in the long term, but let's focus on our dual listing for now.
Thanks, Tim. So how long do you think oil and gas prices will continue to increase? And do you have a prediction on how high? And I guess bringing it back to the company level, how does this affect your revenues and profits?
Well, I mean, there's certainly we're certainly in a period where oil and gas prices are moving in a favorable direction. My crystal ball is as good as yours, I suppose. As far as what impact does it have on our revenues and profits, I think that you're seeing some of that in this quarter's results. There's a lot of forecasts out there that show that oil and gas is going to continue to increase. We're heading into the North American winter, which is typically impactful in terms of prices. And so, my expectations are that we're going to have a good couple of quarters here coming forward. So beyond that, it's difficult to predict. I read the analysts and pay attention to the predictions and stuff, but it's hard to speculate beyond that.
And Tim, just I guess following on from a previous discussion that we had just before, do you plan on uplisting to the OTCQB?
As a matter of priority, yes. We've been talking about uplisting on the OTCQB for a while. We put the gears in motion. We got sort of interrupted with that suspension that we went through. Now those gears are in motion again, and we're pushing as hard as we can to make this happen. So absolutely.
So just if I could just follow up on that, Tim. So what are the next steps for you to uplist onto the OTCQB?
Well, we've hired a group to assist us in that uplisting, and so they have an action list. There's some critical information that we have just gotten over to them, and so I anticipate that the application process will move forward in a much more expeditious manner within the next week or so. As I mentioned earlier, I think the process, is probably going to be looking at another 4 to 6 weeks.
And Tim, do you have any potential, or do you have any other potential partnerships for supplying stranded gas to crypto miners?
Well, the relationship that we have communicated to the market with Elite Mining is a special relationship, and we certainly value that, and we are going to continue to work together to be successful with Elite Mining. It is interesting just how much the phone has started to ring once people started to get an idea that AXP Energy was in the market to supply gas and convert it to electricity for different types of things like cryptocurrency mining. And so, I think that we've released everything to the market that we can at this point. But there certainly is a lot of interest in a lot of different circles of discussion in that regard. So.
And just finally on that theme, Tim, are you looking to hire a chief operating officer or maybe a CCO to manage all the in situ and crypto well developments?
I would anticipate, my anticipation, Alex, is that once we get this first one under our belt and we start to execute on this strategy in a more meaningful way, that the growth impact to the company is going to be fairly profound, and so that of course is accompanied by human resources growth as well. I think that we're well positioned to manage the near-term portion of that growth with what we have right now, but certainly wouldn't rule it out that we need to have a mid-tier person on staff to look after that expansion at some point in the future.
And back to you, Simon. Who's your biggest institutional investor, or I guess inside investor?
Oh, look, I'm going to have to decline to sort of comment on individual shareholder identities. What I'd say is, if you look at our share register, the bigger holders is characterized by a mixture of family offices of well-known investors. There are some small institutional investors, and then there's also some big nominee holdings that are in themselves aggregations of smaller holdings. So in terms of declaring critical thresholds, the onus is on the shareholders individually to report that through us to the market. When they hit those thresholds and we report that, there are other publicly available methods to get that information should people choose to research it, such as Bloomberg. The shareholder registry is constant state of flux, of course, but that's can be questioned and viewed by the public. And also, what I'd say in closing is that we're about to publish our annual report, and routinely we give a profile of the top 20 shareholders in that. So soon people will be able to see, with their own eyes, exactly where that's sitting today. But it's only ever a point in time. So yeah, hopefully that answers the question without intruding too much on the privacy of those individual shareholders.
Thanks, Simon. Now back to you, Tim. Will Amerigo Vespucci and JW Powell be allowed to operate at its full potential with the crypto mining rigs in place? And is it still capable of 273 barrels of oil per day?
So, I mean, it's certainly our intent to operate those wells at maximum capacity. There is a correlation between how much gas you produce from a well versus how much oil you're able to get out of the well as a result of back pressure. And we are looking at some multi-year contracts with elite mining, and so as I mentioned before, it's a bit difficult to predict what the production profile is going to look like with the initial 400 MCF per day that we're selling to elite mining, which I also anticipate to increase once we get that first mining site up and running. I'm certain that we'll be adding some additional sites to help us produce those wells at maximum capacity. Very hard to predict what the oil production is going to be before we have a little bit more history of that arrangement.
Are there any storage capacity issues for oil at any of the sites?
There aren't. At Amerigo Vespucci and Pathfinder, in fact, all of the well sites currently have tank batteries. The only exception to that is the JW Powell well, and so we'll have to install a tank battery to that well in order to bring it online. But a pretty common thing for us to put a tank battery in. And so, no material capacity issues at any of our sites.
And why not sell down the remaining 18,000 barrels of oil in inventory? Is there a hedging issue there, or can you just talk us through that?
A couple of things on that. It's not possible to sell down all of your inventory. For the movements of oil in the Appalachian Basin assets is a bit complex. We have a network of I think there's 364 storage tanks that collect the oil directly from the wells, and then that oil is moved to one of I think 9 sales tanks. And so there's always oil that's moving. You cannot sell. Well, I shouldn't say you can't, but it's not customary to sell partial loads of oil. It's very expensive to do that. And so there's always going to be an inventory. As we get to know these assets better and better, we're trying to dial in what that inventory level really is going to look like. My inclination is that it's going to look somewhere between 10 to 13,000 barrels that we're always going to hold in inventory. And so, we do have some room to sell down, and we are increasing our efforts to sell down everything that we can. But you'll never see, 0 barrels of oil inventory in a company like ours. In addition to that, as far as hedging is concerned, we haven't deployed a hedging strategy. We're looking at that very, very seriously with the price of oil continuing to climb, and we feel that that we can implement a positive hedging strategy on a go-forward basis. And so, I would expect to hear a little bit more about that in the near term.
Simon, do you have any new ideas for getting around flaring restrictions at Pathfinder, not including crypto mining rigs? Is it possible that you could tie up some natural gas to electric generation sold into the grid. Do you have any ideas around that?
Not at this time. I think, we've said many times that Colorado is a very challenging regulatory environment. Things seem to be getting harder rather than easier in that, particular state. The crypto power supply, we see as the most viable sort of, near-term route to, freeing up some of that oil that's in the reservoir. I think specifically with regard to putting electrons in the grid, I think we have talked about that in abstract, and the problem there is that you face the same capex challenges, thresholds, similar to reticulating gas into pipelines in terms of, you need to be able to deliver marketable parcels, so that requires that you have a certain scale than what we have on the ground there. So have we considered that specifically? Yes, we have. Do we think it's viable? No, we don't, because of the, that capex threshold that I mentioned. We continue to stay sort of abreast of, latest thinking technology around that flaring. But at the moment, most of our energies is, focused on building out the opportunity to provide, in situ power generation for gas that's either stranded or not economic to reticulate via this, this crypto power supply sales channel that Tim's been building out.
So just on the sales channel, so a neat segue into my next question. Will you be renegotiating any sales contracts now that the natural gas price has gone up even further?
Yeah, look, absolutely. I mean, we do have some contracts that take us, further out into next year than we would be comfortable with. So what I would say is that we're constantly looking at this to see what opportunities might exist to buy out existing contracts and continue to take advantage of the improving swap prices. But there's obviously, there's a math problem in there which we have to look at, and as the market sort of develops and evolves, and we simply run those calculations to make sure that we're optimizing the contracts that we have in hand and where the spot price is. And as Tim sort of alluded to, going forward, if we take the view that there is a opportunity to hedge, if that we decide that's a good strategy, well then we'll think about that at the moment. But really the focus right now is on renegotiating those contracts either ahead of or when they become due for advantage. And we've done a lot of work in that space already, and it's just a watching brief for us.
How does the company plan to address the aggressive shorting of the stock?
Oh, look, I don't believe that there is active shorting in the register at the moment. Unfortunately, a differential appeared whilst the ASX had suspended trading. But that gap, if you like, is closed once the shares resume trading again. In terms of the whole question of people shorting our stocks, the best defense against that is for management to perform and for the company to deliver results. We operate in a market, and there will be people who take a certain view on the company and where things might go forward. So all we have to do is stay stuck on our game plan and continue to deliver against it. But I just want to reiterate, we don't believe that there's any active shorting in the register just now.
Thanks, guys. A couple more to finish. Tim, can you just provide some feedback on the company review of 111 wells under review and 165 plug and abandoned? Would it be economical and beneficial to bring them online into production? And if so, when might this be?
Alex, this is an activity that goes on a daily basis. We have some abatement obligations to plug so many wells per year. It's fairly modest at 13, but if we can bring a well online, then that counts for one of those 13 wells. And so it's absolutely our intent every year to bring 13 new wells online so that we don't have to plug any. There are some wells that we have worked on, and we know that they are absolutely just not going to pan out, and you're always going to have some of those in your portfolio. So, so when I look at this question, this is something that happens behind the scenes, all day long, every day. And in some cases, it'll be economical and beneficial to bring wells online, and in some cases, it won't. It's a constant fluctuation of wells in our portfolio that are not online and producing. Not sure I answered that well enough to satisfy, but that's just the reality of the nature of what we do here.
And final one for you, Tim. What are the likely capital costs to bring the Vespucci well into oil production? Is it still necessary to build and install a gas pipeline before the Vespucci well can generate revenue from oil flow?
Yeah, so there's a couple of different possibilities here, Alex. The Vespucci well is only absent a tank battery in order to start producing. However, we have the elite mining site set up a couple thousand feet away from the Vespucci well. And we believe that it would be advantageous to bring the gas from that Vespucci well over to that well pad. That way, the mining build out isn't as substantial. We already got the infrastructure there, and so we think the 2,000-foot pipeline build out would be less expensive than to set up a new mining site over JW Powell. That said, we've got a team of people in Kentucky that have just laid, thousands and thousands and thousands of kilometers of pipeline. And quite frankly, we're looking at putting them in a couple of trucks and sending them out there and doing that very same thing out in Colorado. And that's the beauty of having some depth within your operations of your company. So that's certainly under consideration. In terms of cost to bring the Vespucci well online, again, tank battery costs, not overly expensive, in the tens of thousands of range, and then building that pipeline out. I think we're laying, 40,000 kilometers of pipeline in eastern Kentucky for about $25,000. So if you can just kind of extrapolate the answer from those comments, then not a whole lot.
Thanks, Tim. And just finally, Simon, what's the company's vision over the next 3 to 5 years?
Well, look, I think if you want to think about the end goal, what we aspire to be is, a substantial in-basin producer. The analog that we mention, on many occasions for us is DGO, and the position that they've managed to develop through time. We're going to be applying that acquire, enhance, produce approach that I spoke to earlier. We're going to be continually screening new opportunities for growth. We're going to be driving on cost and grinding those costs down and achieving all the economies that we can across the total operational base of the company. Those cost synergies are the best way that we can ensure that the company has resilience in a what seems to be a fast-moving, very peaky energy market for in terms of oil and gas commodities. So I think we're very, very, very conscious of getting that cost piece right. That's critical to our survival and our ability to compete with our peers. And then lastly, as I said, we'll continue to manage the portfolio in terms of systematic retirement of wells to meet our regulatory obligations, and extending the life of wells that are currently producing today through application of cost appropriate technology and methodologies. We're looking for neglected assets, distressed assets, and seeking to bring them into the company in a way that makes sense, and to harvest synergies across those operations. So if we can get out ahead of our peers and develop that scale that we've talked about, then we think that there's going to be lots of pathways for the company to grow, and an opportunity for us at some point to start harvesting the cash instead of continually reinvesting it. Tim, I don't know if there's anything. Would you like to add anything more onto the tail end of that?
Yeah, I guess just that we're willing to think different. One of the things I wanted to say before we conclude this is to thank all of our shareholders that have hung in there with us through that suspension period. I am absolutely certain that wasn't easy, and it wasn't easy for us either. But I think the fact that we're willing to think different is demonstrated in that difficulty and that challenge. But if we find a meaningful way that fits into our wheelhouse about how to improve the value of this company, we're going to fight for it. And that's exactly what we've done, and we're going to continue to do it. And I think that you'll see more and more examples of that going forward. So we're a bit of an oil and gas company that's a bit scrappy and willing to think outside the box to be able to operate in a way that maximizes the value for the shareholders. So it's really just about maybe a bit of culture, Simon, that I would add into that.
Thanks very much, gents. Well, look, that's all the time that we have today. I'd like to thank you all again for joining me, and I'd also like to thank both Simon and Tim for presenting and taking the time to answer some questions. You've been very generous with your time. Now, as I mentioned before, recording the webinar will be on AXP's website and social media platforms later today. Now, Simon, before I let you go, do you have any final comments to leave with us today?
No, I'd like to endorse Tim's comments there at the end. The suspension of trading was a very difficult period. I know that there's a number of shareholders who have been with us for a long time now. They're continuing to show faith in the company and in our relatively recent change in strategy. Hopefully, we're increasingly creating a point of separation with how people perceive the company in the past and the underperformance of the share and so on. We've outlined our plan that we're following, and as hopefully you've got a sense of today, we're continuing to deliver the results in the right direction. Things are heading to the top right corner at the moment, and we're going to continue expending our energy to keep that trend heading in that direction. So thank you to everyone for continuing to support the company. Thank you for your interest. We're trying to do a better job with informing people through time, so hopefully our communication's at a level that people find acceptable. And we look forward to continuing to grow AXP forward.
Fantastic. Well, that wraps it up for us here. Thank you, everyone. Have a great day and all the best.
Thank you, everyone.